Right now, the global commodity market is caught in severe turbulence, driven by forces completely outside the control of everyday buyers. Look at the baseline data for polystyrene. Global demand is noticeably weak. European plants are keeping their operating rates deliberately low, and buyers in China are purchasing strictly for their immediate, short-term needs. But on the ground in India, buyers are facing a jarringly different reality. Local producers just increased GPPS prices by 2 rupees per kilo. Traditional economics suggests that sluggish global demand should pull prices down, yet Indian processors are staring down immediate hikes, with more projected on the way. This disconnect shows that localized demand has lost its predictive power. If you only look at your own order books to forecast the next month, you're ignoring the external pressures that are actually setting the price. 2 major macroeconomic forces are actively overpowering local demand. First, severe geopolitical instability from the ongoing USA-Iran conflict is sharply driving up crude oil prices. Second, the US dollar has strengthened aggressively, crossing the 97 rupee mark against the Indian rupee, applying immense upward pressure to your import costs. This graph shows the collision, a flat line for stagnant global demand intersected by sharp spikes of crude oil and exchange rates. This creates a dilemma. Do you drain cash reserves to stockpile material now, or wait, risking Q3 profit margins being wiped out? Manufacturing margins are no longer dictated by how much finished product your customers want. They are dictated by global geopolitics, operating entirely outside your control. Let's trace the direct consequence of that 97 rupee exchange rate on your raw materials. Overseas suppliers are now quoting HIPS offers for late July or early August shipments, around $1,450 per metric ton, CIF Navasheva or Mundra. When you apply the inflated import valuations maintained by the Customs Department, overseas purchasing becomes mathematically unviable for most mid-tier processors. To avoid shipping delays and heavy currency penalties, buyers are abandoning international suppliers and shifting their procurement entirely to domestic Indian producers. A captive audience has a cost. By retreating entirely to domestic sources, buyers give local producers total, uncontested pricing power over the market. You might step away from the import market to save on currency risks, but you end up trapped in a localized ecosystem where domestic producers hold all the leverage. Here is the official market forecast. GPPS and HIPS prices are highly likely to increase by 2 to 4 rupees per kilo in the near term. This comparison matrix lays out your options. First, we examine the aggressive buy strategy. Committing to bulk purchases today instantly protects your late Q3 manufacturing margins from that 4 rupee hike. But there is a heavy trade-off. This strategy demands available, climate-controlled warehousing and ties up critical operational capital during a highly uncertain global climate. Contrast this with the wait-and-see approach currently utilized by Chinese buyers. They are purchasing strictly for immediate needs, to maintain cash agility and avoid storage overhead, even though it exposes them to spot price surges. Buying early translates the 4 rupee saving into a direct trade against your liquid cash. You are weighing a margin improvement against the risk of a potential operational cash flow drought. To understand exactly why local producers are raising prices despite weak end-user demand, we have to examine upstream feedstock pressure. Polystyrene production requires styrene, which is directly downstream from crude oil. When crude spikes due to war, styrene costs inevitably spike right alongside it. Domestic producers face these non-negotiable upstream costs. To protect their own operational margins, they are forced to revise their ex-works prices upward. The absolute price floor for polystyrene is rising independently of local demand. Processors cannot simply wait out the market, hoping for a localized price drop. While our forecast of a 2 to 4 rupee hike is highly probable, a blanket mandate to buy everything right now does not apply to every business equally. This decision tree reveals the primary qualifying question every processor must ask today. Do I have 60+ days of operational cash liquidity and available storage space? If the answer is yes, execute the aggressive bulk buy immediately. Treat the inventory as an inflation hedge to maximize margin protection. If liquidity is tight, do not over-leverage your operation chasing a 4 rupee margin saving. The risk of bankruptcy from running out of cash is greater than the risk of costlier plastic. Your specific action plan is straightforward. Secure exactly 30 days of inventory to buffer the immediate hike, and hold the rest of your resources in liquid capital. Smart purchasing means your strategy must perfectly match your bank account's reality, not just the raw market data. Geopolitics shift by the hour. These macro-driven margin calculations must be reassessed daily before placing any new orders. The Polymer Bazaar AI-powered chatbot delivers GPPS and HIPS pricing and trend reports directly to your phone. WhatsApp the word PS to 91-93746-24365 to receive automated updates in just 5 seconds. Rely on the authoritative data that drives the industry. Surviving the volatile Q3 polymer market requires moving away from traditional factory purchasing habits. You have to treat your raw material procurement like high-stakes financial trading.